Since 1956, when Malcolm McLean first operationalized the containment cargo industry, you have been in the forefront of this dramatic growth. And today we're going to show you how you can continue to stack up your growth potential. Good afternoon, ladies and gentlemen. I would like to introduce you to my colleagues, Corey, Ada, Stephanie, and myself, Ralph. Our agenda today will start with, I'm not sure why it's not working, but our agenda today will start with talking about your key issue, which is to find an optimal product mix or an optimal revenue mix within this dynamic market. And with that, we want to take you to a place where you can be a worldwide leading containment hub going forward. And we have identified 3 key issues. And with that, we have created a strategy, a 3-pronged strategy, which we'll discuss and elaborate later on. So first off, to give some context where you are today, you're currently, Hutchison Port Holdings is currently one of, or if not the largest player in this industry with about 64 million TEUs per year. HPHT has also grown dramatically with about 23 million TEUs, and you have capitalized on this with your recent IPO. Today, HIT, or Hong Kong International Terminals, is one of the best and has dramatically increased your growth rate for this past few years at 8% compounded annually for the past 16 years. With a 55% market share in Hong Kong, there is a lot of growth that we can see today. But this growth does not come without some key challenges and key decisions to make. One of which is to decide what to do with your operational mix, given that there's a lot of growth within the transshipment side. And this tailwind is something that we must address. Transshipment within TEU has grown 10% for the past 10 years compounded annually. And with this, what are we going to do about it? Well, today, we have realized that in this industry, margins is a big issue. And we have realized that using industry comparables, the difference between O&D and transshipment is about 1.66 times premium multiple. So we have estimated your range to be around 300 Hong Kong dollars spread between your O&D operations and your transshipment operations. So we want to commend you for the past few years, especially during the subprime crisis, where you have done extremely well and maintained your margins extremely well. With that being said, we understand that within HIT, you have capped your stacks to just about 6 stacks. And this limit is something that we have to take note of. But what we want to prove to you today is that this limit does not exist within your top line. So we forecast you to grow at around 7% compounded annually for the next few years. So as I mentioned earlier, there's 3 key issues involved. The first of which is the challenging O&D market. And with that, we have created a sustainable long-term ship partnership strategy, which we call the STRONG strategy. Next, due to capacity constraints within HIT, we have implemented a plan where we will increase the efficiency within your yard, which we call the FAST strategy. And lastly, with increased competition, we encourage you to invest significant stakes in growing ports throughout Asia, which we call the connected strategy. And with this, we will create HIT and transform you into the epitome of transshipment hubs between Asia.
So the first issue that HIT faces is that it needs to maintain its O&D customer base. Since the 1990s, they have been facing many issues. For example, the O&D shipment category has faced 3 issues that come from increased competition due to ports building up in mainland China, and also due to the fact that there is a perceived unattractiveness of cross-border travel. This has led to the decreased O&D shipment. However, given all these issues, HIT has remained extremely operationally efficient, as demonstrated by its above-industry throughput of TEU per crane and per berth. However, this has not been the case for its customers. In terms of the last 3 years, shipping lines has faced reduced margins, and as shown by the comp table, your key customers have also faced compressed margins as well, and this has incentivized them to look for cost-saving methods in terms of its transportation. Therefore, your company needs to capitalize on its key core competencies, which is providing customized services. It needs to build on that, and in order to sustain its O&D customer base, it must establish synergistic partnerships with these shipping lines. So we want to emphasize that establishing these partnerships will help retain these customers in the long term. Later on in the presentation, we will show you that it will improve your company's margins, and also these cost savings can then be transferred over to your more efficient customers. So we have identified some synergistic opportunities for your company. In terms of dwell time, customers whose containers stay shorter at your port will actually help you incur less costs. In terms of billing and administration, if you can integrate your IT system better with your shipping lines, you can help save costs in terms of those systems. And lastly, in terms of yard planning, if these manifests can be transferred over to your company in a more efficient way, we can help your company better anticipate bottlenecks and better use your yard utilization. And therefore, these synergistic opportunities will be mutually beneficial for your parties. So using an industry average of the dwell time of containers of 3 to 4 days, we have established 3 distributions. Under all 3 distributions, you can see that a substantial amount of these containers are actually dwelling at your port for over 3 to 4 days. However, although these are extra costs for your company, you are not charging additional fees for the extra time that they stay at your port, and therefore we feel that where synergistic opportunities come in is where you can work together with your shipping line firms and establish an acceptable threshold where these inefficient customers would be responsible for the additional cost of the dwell time, and therefore you would gain in cost savings because of the increased efficiency and of increased container turnover. Okay, so we feel that this strategy will help you increase your inventory turnover of the containers and also reduce your opportunity costs. We want to emphasize on the fact that this strategy is not a price cut. In that, in price cuts, you're reducing your selling price while costs are constant, and which will erode your profits in the end, and will also induce price wars. However, if we are reducing prices using synergies, although we are providing your customers with a price discount, your costs are reducing because of higher efficiencies created from increased turnover and also from efficiencies because of higher yard utilization, and therefore your profits would actually increase in the end. And therefore these strategies would help you maintain your O&D customer base by retaining them and providing them with tangible benefits. Here's a quick implementation slide. You can start today by building on these partnerships, and later on in 2012, you would be able to establish them and work forward from there.
So we had just heard about how you can create customer synergies, specifically addressing your O&D customers. But how do you address this increased demand for transshipment, given the increasing capacity constraints you are facing? So, as you know, there are many factors affecting capacity, and we've outlined 3 key criteria in order for you to address which of these alternatives is best for addressing the capacity constraint. These are, does it provide economic benefit, is it safe, and is it feasible? So for example, while you may consider investing in barges as a way to increase your capacity, we find that this is not economical, nor is it very efficient. Alternatively, you could consider buying out the space currently leased out to your competitors within your own port. But again, while this is safe, the fact that the Hong Kong government has leased this land out until 2047 means that is not very feasible. The best way for you to go forward in increasing capacity is by simply increasing capacity by directly increasing efficiency by increasing the number of movements per hour. What will this look like? Currently, the industry average is about 28 moves per hour, where a movement is defined as the cycle from when a crane picks up a container, takes it to where it needs to be, and comes back. We commend HIT because currently you are more efficient than the industry, hitting on average about 30 movements per hour. However, you're still not hitting your target of 35 movements per hour, at least not consistently enough. So how do we get you there? What we recommend is actually creating a hydraulic truck lift that will lift the truck into the air, thus successfully cutting the time that the crane is actually spent traveling, carrying your cargo back and forth. So allow me to quickly talk through what this will actually look like. You will install 57 of these hydraulic platforms on your port, one for each key crane owned by either HIT or COSCO HIT. A truck will drive onto the platform and it will be raised an adjustable height. The key takeaway here being that any number of meters off the ground is saving time and money for both you and your customers. We'd like to emphasize that this is a dynamic process, so that as soon as the container is lifted off of one truck, the platform will begin to lower, and by the time the crane is ready for its next movement, the next truck will be able to meet it halfway there, effectively making a much more smooth and much more sufficient movement. Now, the reason we're so confident that this will work is that we've already seen certain forms of platform raisings successfully implemented within the industry, most notably in India. The specific metrics of this implementation, such as the tonnage it supports and the height, are in line with what your company needs. And perhaps most importantly, you are reinforcing your competitive advantage by making sure that you are providing a shorter turnaround time for your customers, directly saving them money. Now, of course, we recognize that safety is a key concern for your company, as it should be specifically in this industry. So we'd outline that not only is this recommendation efficient, it is safe. So the actual platform is very wide, providing the support it needs. There's a secure lock-in mechanism for tires, so even suspended in the air, these trucks will not be going anywhere. And finally, one thing we would advise, just as an extra precaution, is that you would not be using these platforms in days where it's supposed to be relatively windy, based on the Beaufort chart. Instead, you would be continuing operations as you do today. In fact, nothing else would be changed. What this will look like in terms of costing. So we've outlined that initial capital invested would be about 675 million Hong Kong dollars. And what this will cover is your R&D, the actual design of the platform, the installation, the implementation, and training for operators so that they're comfortable using this. What it will look like in terms of payback for you is based on the simple 4 additional moves an hour and the incremental revenue you can generate from this, working with the assumptions of EBITDA of 55% and a crane utilization of 80%, you can be expecting to see annual EBITDA of about $500 million with a payback period of just over 1 year. In terms of our implementation, starting tomorrow, you can already begin designing the actual platform that will work best for your port, and we predict that by the end of 2014, you can have these platforms successfully integrated into your day-to-day operations.
Now that Ada has discussed how we're going to increase your capacity, I want to ensure that it's always filled. Now we look, there's increasing competition, not just within the Pearl River Delta region, but within Asia as transshipment hubs. Now, we're going to provide some information that I'm sure you're already aware of. China has been growing at a 20% average for the last 10 years. And as we look forward, you are already increasing your investment within China to currently 10 million TEUs per year, but there's 125 million TEUs spread throughout China. And your competitors are moving very strongly in that region as well. We're looking just towards MTL. MTL has operations in Xiwan, Siku, and Daochen Bay, and we're encouraging you to begin some investments as well. Now, I want to make sure that you have the money to make these investments. So we've done calculations looking at HPHT's cash flow to see how much money is available, and we estimate it very conservatively to be $9.9 billion Hong Kong. So what this takes into account is the debt covenants that are in place, as well as the committed capex for the next several years, and we've very conservatively estimated given a margin of safety of 40%, so that if there is any EBITDA volatility, you will be safe. However, even during the recession, it was very minimal, so that's a very minimal risk. So for these investments, we outlined 3 criteria that you must look for. The first is that there's significant market flow so that you can purchase these or receptive stakeholders. Secondly is that you can buy a sufficient amount of it to have some kind of management influence. And thirdly, that the valuation is good and there's strong growth potential within this organization. Now, we've looked and developed a process that you should use when screening. So the first is to look for the strategic locations that you want to invest in. Secondly, look at the ports that are available, so public and private. From there, look at the stake that might be available and whether the valuation and there's a strong accretive potential. So we have produced a comparables table looking at not just local competitors, but international. And I'd like to draw your attention to one in particular, which is Xiamen International Port. Now, a few things about it. It's in the Fujian region. It has 4 million TEUs and a 10% CAGR for the last 3 years. Now, what's very important, there's 2 factors. First, that there's 33% of the market, the value is floating right now, so you can buy it through a market transaction. And secondly, that its EBITDA margin is 25%. Yours is currently nearly 60%. This indicates that there's a lot of inefficiencies within their operation that you can provide benefit through your management expertise. We have produced a valuation. So we've looked at the valuation from 2 different methodologies. This establishes that the intrinsic value is approximately 22 cents, US cents per share. It's currently trading at 15 cents, so there's a premium of 33%. Now we're recommending that you buy it through a 100% equity stake which will cost only $120 million, which is 9% of the current capital that you have available to make these expenditures. And through this equity stake, you can focus on providing efficiencies to the organization and adding accretive value, which will accrue to HPHT, as well as creating a great relationship with HIT, which can be used to become that transport hub for all of Asia. Now, we've also identified some other ports that we would like you to invest in after making this first initial investment in Xiamen. Now, what is the value to your organization? And I'm going to look at it from two different perspectives. First, from the perspective of HPHT, and secondly, from Hong Kong International Terminals. Now, you've already proved through Hutchison Port Holdings Limited and operations in 25 countries that you can effectively purchase into a port and provide operational expertise that adds value to the organization. So this model that we're outlining is already proven to be successful. Now, HPHT does have the money available to make this investment and has the technology and expertise that will provide value to the port. Now, if we look at it from HIT's perspective, there's two major things we want to focus on. This is going to be the port relationships as the first one. There's a lot of inter-logistical efficiencies that can be come from this. So essentially, a shipping line is dealing on both sides, the to and the from destination, with one organization. So this allows you to produce efficiencies within your port operations, as well as aligning incentives between the organizations and encourage the shipper to act in a way that is beneficial to you. Now, the second is the end customer relationships. By having these incentives, you can encourage something like a just-in-time delivery system. We've already identified that dwell and your capacity within your organization is very minimal. It's the constraint that is holding your profits back. So instead, if we can shift some of that dwell time to Xiamen, where there is much more space available to other ports, and just bring it in at the time where it needs to be transshipped onto another vessel, this will increase your overall efficiency. So that's just one of the synergies that is available. Now we look forward, what's this going to do? It's going to turn Hong Kong International Terminals into the transshipment point for all of Asia. Now I've identified a strategy here, implementation plan for how you can go about this investment, but also you can see that it includes the other investments which we are strongly encouraging you to make for the next several years.
Thank you, Corey. So by creating a symbiotic relationship with your clients, and by increasing the efficiency of your firm, and lastly, by increasing and widening your net throughout Asia, we firmly believe that HIT can transform into the transshipment hub within intra-Asia operations. So as we've mentioned earlier, there's three key issues. First is the headwinds that you see in the O&D market. Second is your lack of capacity in HIT alone. And third is the rising competition. And with that in mind, we've established three key strategic recommendations that integrate with each other. The first of which is within this industry, relationships matter a lot. And with this relationship, we want to establish a long-term sustainable partnership with our key clients, be it the manufacturers or the shipping lines, and prove to them and show to them that we're with them during the good times and the bad times by making sure that we increase their revenues, they increase their revenues, we increase our profitability, they increase their profitability. And moving on, we have the capacity to do it now because we increased our lifts per hour to 35 instead of 31. And moreover, to complement all that, you created a strategy throughout Asia wherein you have hubs all over, integrating all your operations, making it more efficient for them, making it flexible for them in case they want some just-in-time deliveries that they may need. So together, we can create a strong, fast, and connected enterprise that will truly transform HIT to become the epitome of the transshipment hub in Asia. So here's an aggregate overview of our implementation plan, as well as some key risks and mitigations that accompany our recommendations. And that being said, what I want you to focus on is top line and margins. So we forecast that with our strategy, you can increase your top line by about 7% for the next 5 years compounded annually, and the same goes for your EBITDA. So we have focused that you can increase the value to your stakeholders, be it trust units, creditors, clients, but you can also increase value to your clients. You can also increase value to the management team. And in this way, you're currently getting a $21 million base fee with the management trustee compensation. And with our plan, we can add another $4 million management performance fees through our strategy. So really, clearly adding value to everyone. So overall, we started in 2010 with a 60-40 mix between O&D and transshipment. But 5 years from now, we see that changing to 70-30% mix. But what I would like to note is that you're not losing your O&D market. Your O&D business is continued to be intact and growing organically. But the reason that the mix is changing is a function of increased volume, increased revenues, increased earnings, and increased profitability of your transshipment segment. So together, we will truly transform HIT to become the transshipment hub in Asia and continue your robust growth going forward. Thank you so much for listening to our presentation, and we would like to now open the floor for questions.
First time I hear this India cargo platform concept. Can you elaborate it more? I don't understand how it works.
Sure. So what's happening in India right now is the same idea of a raised platform. But in India, what they did is they actually embedded the technology to be underneath the ground so that they raised essentially the dirt up with it. So they performed a rise platform in that sense. Now we looked at this, if this is applicable for your ports. However, we found that given that it's built on water, it wouldn't be as efficient to make it in that sense. And secondly, there simply isn't the room. So we just used that same idea of what's happening in India and modified it to make it work within your own ports.
After you load the box on the chassis on a platform, where does it go?
So you load the box.
And they come down from the platform.
Right. So as you can see, and then the truck can just keep going because it's dropped off its container, and the next container will be able to be loaded onto the ship.
What's different between on a platform and on the ground?
So it's higher. So essentially, you're cutting the time that the actual crane needs to travel to pick up the platform. So instead of going all the way to the ground, it can even go further. Instead of the crane needing to go all the way to the ground to pick it up, perhaps if you raise it even 10 meters in the ground, it can pick it up from there, leading for smoother movements.
Do you think it will take more time to lower the platform back to the floor level than the box that's dropped another 10 feet on the chassis?
Right.
Which is faster?
We definitely believe this is more faster in that you can adjust how high you want to raise it depending on the needs of the actual cargo you're dealing with and the containers and the ship or the trucks, whatever it may be. In this sense, you're saving the extra time, essentially that last bit, to make it more efficient and smoother.
Give me the website of this company.
We'll look into it.
Okay, so this does look like a very interesting idea. And I buy theoretically how it might increase efficiencies. But it would increase efficiencies moderately. It seems to be your main avenue for HIT moving forward is to buy into ports in China. So it's sort of like you're giving up on HIT in Hong Kong and really aggressively going into China. Is that a fair characterization?
No, I don't think that's a fair characterization. What we're doing is we're buying into China in a way that provides value to HIT. So I think that by increasing the efficiency of the port, it eliminates that capacity constraint that's currently constraining your profits. So what we're doing is we're trying to buy in and ensure that the transshipment cargo goes to Hong Kong international terminals versus some of the other ports that are certainly competitors, Singapore, Busan, and South Korea. So what it's doing is supporting Hong Kong international terminals to be the major transshipment hub. And that's the way that we believe that you can grow. So you're ensuring that you're efficient and then also ensuring that the cargo goes to you. And we believe you can do that by aligning the incentives with the shipping carriers because you will be dealing with them on both sides of the transaction so that you can ensure that the incentives go. The shipping line chooses Hong Kong international terminals as their major transshipment point.
Sure. Can you explain that a little more? Because I'm not sure I understand how buying a port in Xiamen or investing in that will increase, having two ports will increase the synergy in Hong Kong.
So the way we think about it is that there's a lot of ports that are going within China,
Right.
and a lot of them have the decision to either go to Hong Kong or to Singapore because of the mandates and regulations within China. And what we want to do is to make sure we have a position big enough within the board seat or a voting power. So what we can do with that is the minute we have a position, for example, in Xiamen, we can integrate our systems together and we become the one-stop shop for these shipping lines. So if we can tell the shipping line, okay, and the port, since your O&D is going to Xiamen, with our system, it will become more efficient to go to Hong Kong International Terminal instead of going to Singapore. So because we have enough voting power within either the board or with the management team, we can make sure that they go to HIT.
Oh, so the ships would still come to HIT first, and then you're talking about transshipment, then
Yes,
to
yes. So it's to grow the transshipment operations, not the O&D operations.
Let me comment on this one. I think what you're trying to tell us is that if you run a port, you can instruct or lobby your customer to go where? For the next stop, right? Just like when you run an airport, you tell Lufthansa to fly to London, instead go to Heathrow, not Heathrow, Frankfurt for transshipment. That is, I would say, quite difficult, if not impossible.
I would certainly agree with you. I don't think that you can dictate, but you can provide incentives to induce that action. So the margins within the industry are very, very tight. So by increasing the operational efficiencies, which was what Steph talked about at the beginning, the operational efficiencies, and we can reduce the cost between the two organizations so that cost reductions can then be passed on along to the carriers. And so it's the cost reduction, and they're going to look at it for finding the best economic picture, and whatever the best economic option is going to be the transshipment point that they're going to choose. So all these strategies combine to ensure that the costs are reduced for the carriers, so that's the reason that they're doing it. Certainly we recognize that you can't dictate to a very large corporation what to do, but you can make it in their best interest to take that action, and that's what we're encouraging you to do.
I think you're suggesting a package deal between Xiamen Port and Hong Kong. I think we have to ask the lawyer about antitrust before we can think about it.
Okay, I have actually two questions. Okay, first one addresses this raising of the platform itself. Why not just lower the level of the vessel, which you can? Okay, you just lower the value. The vessel itself to the same extent that you're trying to raise the platform itself. Then you can get everything all very, very quickly. That's question number one. Question number two is that, we talked, you spent a great deal of time on O&D, origin and destination cargo. Hong Kong, with a population of 7.5 million or 8 million people, we're not a manufacturing center. Our consumption is very, very limited. And we don't produce anything. So most of the cargo physically actually goes somewhere else. Why don't they just go there instead of coming through Hong Kong if, we can't be competitive? So why spend so much of our energy and time trying to, to realistically say, oh, let's improve our efficiency and so forth and so on, when they can go O&D to directly? Okay, so again, that's my second question.
All right, so I will address your first question, and that is, why are you raising the platform versus lowering the vessels? So we agree that lowering the vessels potentially could provide the same benefit, but what we do like about our recommendation, while we do believe it is in fact more efficient, is because it's happening right on your port and you have complete control over it. And the actual technology, the hydraulic lift, it's not brand new. It's not out of the blue. And the fact is, this technology has been implemented successfully in very many industries across the world, and we believe it would actually work very nicely within your operations.
Let me just challenge you on that, if I may.
Go ahead.
Okay, as a professor, but also an ex-naval officer, I can tell you lowering the vessel is very, very simple. Okay, and it doesn't cost very much.
Potentially, we could implement both strategies and just further enhance your efficiencies.
Okay, so let me focus on the aspect of the O&D. Okay, so our main objective here is to retain your current customers. So mainly our goal is to provide them with as much tangible incentives as possible. So what we're doing is we are trying to reduce our costs, reduce your company's costs through increasing the inventory turnover. And through that, we are passing these cost savings directly to your end customers of the shipping lines, so that your company can retain them in the long term, and that we're not just battling on the fact that your company has a powerful IT system and providing good services, and that they're actually receiving a tangible aspect to the partnership in itself.
And if I could add on to that, with regards to your other question as to why we are spending so much efforts within this space, it's all about margins. So during the subprime credit crisis, the biggest thing that management did was to do cost-cutting measures. And why would you do that? It's because this industry is all about margins. Obviously, revenue is a big factor, but the minute your margins decline to some extent, you lose that. So we've noticed there's a 300 Hong Kong dollars spread between O&D and transshipment. Again, this is just an estimate given the limited amount of data we have gotten, but this is an industry average of the premium between those two parts. So when you're selling, when your margins is declined, given that you lose all that $300 Hong Kong premium, then the profitability of the company will decline. So what we've tried to create is to make sure we keep that spread. And these corporations, given your 60-40 split today, there must be a reason why they're still dealing with you. And that is because of your core competency with regards to efficiency, as Steph mentioned earlier. So having those two combined will help you. So having those two combined will help you going forward. Moreover, again, within the product mix that we showed you earlier, you are shifting 60-40 to 70-30. But that O&D business is still remained intact and are growing organically, but margins actually increase more. And the reason margins increase more because the volume within the transshipment side will decrease your margins because overhead is spread out more. So there's a lot of variables coming into play, and this plan is integrated as a whole.
Again, great job on a fantastic presentation with a, I guess, very nice mix between investment banking and port operations. But coming to the investment banking piece, and one of the, I guess, the central platforms of the value addition, if you like, was the ability for the management of HIT to be able to reduce costs through transfer of management expertise and something or the other, right, to the other port. How feasible do you think that is, given what you know of the competitive advantages of HIT and how much of that is transferable?
I think a lot of it is transferable. So if we look
at... So if you do think a lot of it is transferable, why do you not think that the other ports have not done it yet?
So I think the benefit of Hutchison Port Holdings Limited, it has properties in 25 different countries. It owns a lot of ports. So there's the expertise that has already been shown to be transferable by buying in and improving the operation. So we believe that shows that your company already has the skills to do that. On a more local scale, we see that the vast difference between the EBITDA margins between 25% and 60% is a demonstrative of the efficiency that your organization has in Hong Kong. And certainly a lot of that comes from systems such as the information technology systems, the guider that efficiently uses the platforms, the fact that you always, essentially your information systems can run your business in the most efficient way. And we think that the organizations, these ports, don't already have that. So that this is a way to buy in, provide value in just accretive potential of improving those ports, and then secondly, that there is the benefit to that transshipment hub. One of the reasons that we don't think that a lot have bought in, there are constraints within China on the amount that you can purchase. That's why we also recommended that you look for ones that have substantial market flow or stakeholders that are receptive to a minority shareholder coming in. So that's why we recommended Xiaomen, which has a 33% float on the open market, so you can buy it up in that way. So I think that might be one of the reasons that other ports haven't done it. Secondarily, we also see that MTL, one of your competitors, is beginning the strategy of buying in. And we think that if you don't take this movement now, that they will choose to do this, and they will lock down a lot of those ports and try a very similar strategy than we've outlined.
Hello. By the way, Hutchison Port Holdings already have an operation in Xiamen already. So if we are to buy any, then we'll probably buy the ones that operated by our group. That's number one. But just, you guys did a very detailed analysis on dwell time. One question is, did you separate between dwell time for O&D cargo and dwell time for transshipment cargo? Because transshipment cargo by nature has longer dwell time. And if you are proposing that we start charging for boxes that are beyond the dwell time, would that actually push away more transshipment volume?
So no, we didn't have the information to separate the two. What we did is we produced a variety, 3 cases and a distribution based upon the averages that we found for your corporation. So we produced potential distributions. And from this, we can see that some are in the high cost range. Certainly, we do agree that the transshipment cargo needs to sit there for longer. It has to sit there for longer, but we think that your prices hadn't been looked at in 20 years, as we were told, and that the frequencies between the shipments, you have 238 frequencies per week that we could potentially encourage some of the shippers to put it on the next available boat and things like that. And we believe this would be a strategy that you could use during your bargaining negotiations and asking them to see what ways in which they could decrease their costs to you so they could operate in a more efficient manner. which would allow you to go in a more efficient manner, and then you could achieve a price reduction to them. So it's in their best interest to try to find that, and it's also in your best interest as well. So this is more of a strategy for encouraging your business development team to be more of a consultant to these firms, to look at what synergies do exist and how you can encourage them to interact that way. Certainly some may not enjoy paying higher prices, obviously, but it's more looking for what ways can they do that. And we also look at the fact that your capacity is very constrained.
Thank you very much.
Thank you, Team Mongkok. Ronald, shall we take a 20-minute break before continuing on?
Sure, refreshment will be served in this room. Please enjoy. Thank you.